Commercial mortgage. A commercial mortgage is a type of financing for the purchase of a property intended for commercial use. There are two main uses for a commercial mortgage. First, owner-occupant mortgage, designed for businesses wishing to purchase instead of renting premises to occupy as a workspace or expand their existing operations area. Second, buy-to-let financing, intended for investors who seek to gain from buying a residential or commercial property and letting it out for renting. While the rental income can be used to pay for the mortgage, investors also can gain if the property market rises. How does it work? In a commercial mortgage, lenders require collateral. Typically, the property you purchase is pledged as collateral, so if you default, the property you have been paying for, supposedly with the end goal of having legal claim over it, will be taken away for lenders to liquidate as compensation for their loss. In the United Kingdom, lenders can release as much as 70% to 75% of the property's purchase price while they require that you fill in the remaining balance. Some lenders are willing to go beyond the maximum loan-to-value ratio. Such an arrangement is a welcome offer if you can't pay for the balance outright but have another asset to pledge, and the lender accepts as collateral. How to qualify? To offset the high risk associated with commercial mortgage borrowing, lenders have several essential criteria set for applicants to meet before giving their approval. First, your credit rating. Your credit profile shows how responsible you are in handling your debts. It also shows your punctuality in repayment terms. Second, the deposit you can afford. The average maximum borrowing lenders can provide is 70% of the property value. This means you should prepare to shell out for the remaining balance. Some lenders, however, can apply maximum loan amounts when your deposit falls short of the minimum deposit amount. Third, your monthly net income. This derives from all sources such as salary, commission, bonus and business profit. The total should also deduct all monthly expenses and financial outgoings to check how much you are left with in a month and if that suffices to pay back for the loan. If you are purchasing as a group, the income of individual buyers will be summed up. Fourth, the type of borrower. Lenders will look into whether you are an individual or trade as a limited company. Meanwhile, there are some areas of standardization drawn out differently between owner-occupant mortgage and buy-to-let financing. For the first type, since the owner of the business will be the occupier of the place and payer of the mortgage, lenders will look at the financial strength of the company and its capability to fulfill its obligations within the agreed contract term. For buy-to-let financing, lenders prefer loan applications from people with experience in property development. However, novices are welcomed if guided by expert advisors. Compare loans. Various lenders from high street banks to niche alternative lenders offer commercial mortgages. While most interest rates for this borrowing are calculated on variable terms, meaning monthly repayments could go up or down depending on interest rates, there are numerous lenders flexible in tailor-fitting your options for repayment. Here are some of the widely tapped lenders that offer a wide range of fixed and variable rate mortgages. Lender's name. Assets capital, loan size. Not disclosed on the website. Maximum loan to value. 75%. Repayment term in year. 20. Lender's name. Aldermore Bank, loan size. £25,001. Maximum loan to value. 75%. Repayment term in year. Not disclosed on the website. Lender's name. Barclays Bank, loan size. £25,000. Maximum loan to value. Not disclosed on the website. Repayment term in year. 25. Lender's name. HSBC, loan size. £25,001. Maximum loan to value. 75%. Repayment term in year. 30. Lender's name. White Oak UK, loan size. £25,000. Maximum loan to value. 70%. Repayment term in year. 25. Loan tips, things to consider. The valuation method used. Understanding the way your lender used in estimating the property's purchase price is critical, as this determines the maximum loan-to-value loan, as well as the minimum deposit required. Open market value, the best price, based on certain assumptions, at which a property could be sold. 90-day forced sale value, the value that the property would be expected to sell for in a forced sale situation, which is typically the fate of a defaulted mortgage. Because it factors in the urgent need to liquidate the property, This method yields lower pricing than other valuation methods. Going concern value, most suitable in measuring properties occupied by a business. This method puts a value on the traffic pulled in by the company operating in the property. There are several additional fees to consider. Some lenders levy one or more kinds of extra payments, such as those meant to cover the arrangement of the purchase, valuation exercise, and legal representation for you and the lender, which can be costlier if conditions in purchasing the property is more complicated. If you're engaging a broker, expect to pay a fee of up to 1% of the loan value, the usual price brokers seek in exchange for their services. You could rent a portion of the premises to another company. Some lenders allow for such an arrangement, making for an excellent option to make sure that you keep up with those monthly repayments. Provided a competitive and flexible finance package. All in all, would certainly do it this way again.